All right. So we prepared a session with a few questions related to what I was talking. First of all, thank you for being here. Thank you for joining us. Rafa, I know you've been on a plane for the last 6 months, if not the year. Did the same thing with you. Well, all of us, I think we've even...
Not like you, though. As original.
Yeah. So first thing is, why don't you do a quick introduction? Tell us about you. Tell us about your firm. You have a bunch of LPs in the room, meaning that you might as well tell us what makes you different. Why don't we start with you, Rafa?
Sure. Thank you, Fed, and thank you, Endeavor, Alan, for the invitation and for everyone here. My name is Rafa de Haro. I'm a partner at a firm called Cometa. We're a venture capital firm based out of Mexico City. Been around since 2012. And we invest in software companies serving Spanish-speaking markets. And I'll get into why that's a main differentiator in a second. Since 2012, we've raised 3 funds. We're currently ending the deployment of Fund 3, and we're starting the fundraising of our 4th fund, which will be a 2025 vintage. Fund 1 has been completely returned, and so we're currently actively managing Fund 2 and 3. I guess part of the question that Alan sent us yesterday is how do we differentiate ourselves vis-a-vis our peers? What you'll see in Latin America is that there are 3 flavors of geographic scope within thesis, right? You have country-specific funds, which really the only country that sort of supports or can support a country-specific fund today would be Brazil. Number 2, you have the funds that were born or in Spanish-speaking markets that typically do Spanish-speaking Latin America. And then you have the regional funds, which are typically Brazilian funds that got too large and only do Brazil and all of Latin. We're none of the above. We have a global Spanish-speaking mandate, which, to be honest, only includes Spain and the US Hispanics in addition to Spanish-speaking Latin. But what's really interesting is that block represents together the 3rd largest economy in the world by GDP after the US and China. And what's really interesting is I think the jury's out for Brazilian companies that have been successful in Spanish-speaking Latin or vice versa. And I think the successes will come, i.e. Nubank, Mercado Libre, and so forth. But the software companies that are being built out of Chile, Uruguay, Argentina, and so forth, that have been successful in other Spanish-speaking markets is very well documented because software travels really well with language. And so it's a very, very interesting region. Happy to delve that into a second. But I think that's the main differentiator from us, between us and our peers when it comes to thesis, now that everybody has moved into early stage tech.
Dilek.
So, Dilek Dayinlarli. I am one of the co-founders and managing partner of ScaleX Ventures. We are an early stage fund. Our mission is to find the founders early on, but also help them and support them with the operators around them. That's our innovation. Actually, I wanted to do Andreessen Horowitz, but more capital efficient way, in an emerging market way. But also me and my co-founders, we are fortunate to invest in or build some of the iconic companies out of Turkey. Like Upstream, my co-founder here, he created the top player in incident management and sold it to Atlassian. My other co-founder was at Peak Games, actually nothing to tell here. Also, I was investor at Series A to Insider and Picos Security. But we also share our caring with our founders. Why? Actually, being here is so unique for me. 12 years ago, at an Endeavor event in Palo Alto, I met Kauffman through that event, and seeing Endeavor's ecosystem and how much value they create, it inspired me to build ScaleX, actually.
Alan, you don't get to you get to present. What is Endeavor Catalyst?
Endeavor Catalyst is the global co-investment fund of Endeavor.
Right.
You might have heard about it. So, Fair, can I make one comment on these guys?
By all means.
I'm so glad you guys came. I'm so happy you're here. Rafa has an incredible deck for his new fund, and he sent it to me a few weeks ago, and it calls out his 7 biggest winners. And I was like, Rafa, 5 out of your 7 are co-investments with Endeavor, right, in Spain and Latin America. And I was like, you got to come talk about this. So I was just very, very happy you came.
Thank you.
And for Dilek, for Turkey, some of you know, because I've been posting about this on LinkedIn and trying to make some noise about it, we have an 11x cash-on-cash return investing in Turkey. And I don't think the world believes that you can make a lot of fun. Yeah, the Turks are in the front row. Etkim girişim, sürükli girişim. I just think Turkey is an incredible market, and I think Dilek's thesis is awesome. So thank you guys for coming.
Fully agree. So one of the questions that we have for each of you is, we've been talking for 20 some years that there's an opportunity outside of Silicon Valley. Why is that? What is that opportunity outside of Silicon Valley? You mentioned capital efficiency or whatnot. So why don't we start? Maybe Alan, give us a brief overview of what you think is different, and then Dilek, then Rafa.
Look, talent is globally distributed, right? The amazing people are everywhere. Endeavor has believed that now for almost 3 decades. I think we can definitely see that it's true. The question is, can you build really big, meaningful companies everywhere? And can you get venture-style returns? And can you get liquidity? I think a lot of what we've been showing today is that the answer is increasingly yes. And in fact, if and when you do, I think the outcomes can be even bigger, partly because believing in emerging markets is still a fairly contrarian view, right? And Fernando, you'll remember when we were starting Catalyst with Joanna and Nick and Reed, Reed Hoffman said to us, well, look, venture is not actually that complicated. I mean, it's hard. I'm not saying it's easy, but it's fairly simple. It's fairly basic because you only have to do 2 things. First, you have to be contrarian, and then you have to be right. And I think things like what we're seeing now today is like Endeavor's been contrarian for a very long time about emerging markets. And increasingly, we are showing that this is right in Latin America, in Turkey, in certain places. And so, of course, for Endeavor, we're going to push further into Pakistan, into Ukraine, into sort of the next emerging markets. But I really do think we're starting to see this as possible everywhere.
So I was talking to World Bank, and they're looking at the number of companies built all around the world, and taking out of the US, China, and the Western Europe, 1/4 of the companies are coming out of the emerging markets, and India is the biggest chunk in that, and Latam. But then Turkey is 15% of the companies, or Middle East is almost 30%. So we see it's growing really fast. And if you look at also the highest growth, it's happening, as you say, in Middle East. When we were in Saudi, we see that also Turkey. But to give you the real example, when I was in Palo Alto 12 years ago, I'm like, wow, okay, this can happen. My first sophisticated investment was, okay, payment fintech worked in US. So let's go find the best entrepreneur who can do it. That was easycle. That was really sophisticated decision making. But then you start to see founders like Hyundai, Korai. So they learn, and after one generation of success, they create spillovers. So that's what I see now. I think it's in an inflection point for a lot of emerging ecosystems to create bigger success stories out of it.
Yeah, can I insist? Just you did mention capital efficiency before. Compared to Silicon Valley, why is that? Why is that an advantage, and why is it happening?
Yeah, actually, I have a real example too. Berkay, my co-founder, he founded the company in Ankara. The whole engineering team is in Ankara, but the sales team was in US. 1/4 of the cost, and you have the highest quality of engineers to build the best product in the market. So that makes a big difference. So it's coming a bit up, let's say 1/3, but still you have an access to highest quality of people that you can work with. That makes a big difference. Also, the $1 takes them longer along their journey. We were making a calculation at the back of the paper. It's like if you do $500 billion exit in Turkish market, or let's say using the Turkish talent, probably you need a bigger exit value to create the same value out of that investment, almost third or tripled.
Just out there, I think that's the economic aspect to it in terms of cost and talent. I think there's a more qualitative thing also that Latin America, for example, is drastically underfunded when you compare it to Southeast Asia or other regions around the world. And so there's a cultural thing where entrepreneurs for the past 20 years have had to build their companies with very, very little or scarce capital. And so that builds a certain resilience in them. So global investors, when they come into LATAM to look at the local companies, they're very surprised at whether they're profitable or not, how capital efficient they are, because they're not used to just having this massive amounts of capital coming in.
Just adding a small note, actually we have a data point with 1,000 companies, analyzing all the data of the companies. Usually Latam and Turkey are the most capital efficient. You can see on the chart that They're outliers always.
Rafa, you want to add anything on the differences other than capital efficiency I mentioned?
I think sort of what's interesting about emerging markets, what Alan said, I want to build on the sort of how you can get larger outcomes in emerging markets and in sort of more developed markets. And I think what has happened, I think it's the framing around the large, huge structural challenges that you have and how that represents massive opportunities for investment. So a big example is Alan talks about waves of innovation. I'll tell you about sort of the cycles that we've seen, but the first cycle when we started the firm, we had a lot of like top MBA students from Mexico, for example, that were going to top schools here and coming back. Very, very smart entrepreneurs, but what they were doing is that they were copying models that were successful in the US and trying to replicate them in Latin America. And that was largely unsuccessful, mainly due to the fact that they were not solving the main problems first. So there was a sort of an infrastructure in place to make payments and to have logistics. So you can pay for your products or just get them delivered to your door. And so that realization for entrepreneurs was that why don't we focus on the actual local endemic problems? And those represent clearly the largest opportunities. And so that's why the second cycle in Latin, specifically Mexico, for example, all the large successful outcomes are fintech companies. And because entrepreneurs realized, hey, here in Mexico, there's just no servicing of fund. And there's the population is underserved or just not served at all when it comes to financial services. And they saw an opportunity to crack that with technology. And so if you take the top 5 startups in Mexico by, say, valuation and revenue today, they're all fintech companies, right? And so I think that's a big part of what makes these countries attractive. We have large problems that require large solutions that turn themselves into huge opportunities. So.
And Alan, you have this point that it's not necessarily the invention of exciting new technology that is driving success outside of Silicon Valley. It's more solving problems for the majority of the population, one way or another, whether it's with software or hardware or brute force. No, let's talk, because I have the impression that the people in front care about liquidity, maybe, and
Show of hands, who cares about liquidity?
And yeah, so there's an issue in liquidity. But recently, at another event that we had, one of our top people on the list, Justin, he's talking about liquidity, saying, well, illiquidity is not a bug; it's a feature. Illiquidity is actually good for the industry in that the worst thing that can happen in a power law dynamic that the venture capital industry is selling too soon. You just mentioned Globant. I remember we made a decision to sell our shares of Globant when the lockup period expired at $500 million market cap. If we had waited a year, it would have doubled the MOIC because it was worth $1 billion. Today it's worth $10 billion. So sort of illiquidity is accretive in value to startups. So because they don't sell that soon. Of course, it's bad if you're fundraising right now and asking LPs for money because they don't have the money because it's all illiquid. But that's sort of the traditional Silicon Valley approach. What's happening in the rest of the world in terms of liquidity, and what are you seeing?
Yeah, so I think we see from Endeavor's vantage point that the best global companies, as we talked about in the predictions, will continue to go public in the US. I think the US is the destination for that. Interestingly, I think that's also true for the best and biggest Latin American companies, right? So if you think about the path that's been laid down now by Mercado Libre, Nubank, Globant, Vtex, Stone, PagSeguro, dLocal, you've got 6 or 7 big, meaningful LATAM technology businesses that are listed here in the US. In fact, if you go to the predictions, we name some of the ones we think will go next. And I actually believe that the venture capital world will start paying a little bit more attention to Latin America once there are 15 publicly listed tech businesses. Once you actually get iFood and Rappi and Creditas and some of these businesses to be public. That's a hypothesis. But big picture, Fernando, I agree with you, or maybe with Justin's somewhat contrarian view, which is good for him because he runs a secondaries fund. But the illiquidity is a little bit of an interesting feature that enables compounding, right? And actually really does enable us to play a very long-term game. And maybe that's the point I'll highlight is this is a very long-term game. And, we're in year 12 of building Endeavor Catalyst. And I still think we're kind of in the early innings of seeing the full potential of what it's going to become.
So actually, really mirroring the Endeavor's view. One of the Endeavor company, JumpCloud, just acquired one of our portfolio company, Insider, which I invested, get a secondary. So we see a lot of strategic buyers creating liquidity for the market. But obviously for the long run, since we are a really young fund, 4 years in, it's still early to see our IPOs, but that's the aim for the long run for sure.
I tend to agree with Justin conceptually, but I think it's kind of benefit of hindsight first, and then, or you have to be like established manager and like later funds, or how to structure a very unique structure like Endeavor. I'll give you 2 anecdotes to illustrate why I think it's otherwise in some cases. In our first fund, we invested in a company out of Spain called Wallapop, very, very early, right? And then about a year and a half later, we had the opportunity to exit our full position via secondary opportunity that would pay us close to 30x our capital. We had no idea what to do. We were complete amateurs. And so we called our mentors in the US. And of course, they all said, like, you're emerging managers, first-time fund. You guys should sell 100% of your position today. And because we were amateurs and inexperienced, we said, like, we should hedge because this might be the beginning of the curve, right? And so we sold, I think, about 75% of our position, and we kept 25%. And that was, we invested in 2014, we exited in 2016. After 2016, guess how many offers or opportunities to liquidate that 25% we've had? 0, right? And so that was a huge lesson for us. And the second anecdote is we built on that lesson. And in Fund 2, we co-invested with Alan in a company called Pizza that he showed. We came into that company at a $10 million valuation in 2015 or 16, I think. In 2020, there was a round that valued the company at $200 million. So that would have been a 20x return, right? On valuation increase at least. And it was the middle of the pandemic. We had learned our lesson. And there was a secondary opportunity for a chunk of our position, and we took all of it. That was a big chunk of it. I mean, not substantial, not more than half, but a big chunk. 6 months later, the company goes from 200 million to 2.2 billion valuation. So that hurt. It hurt so much. But we were able to sell at that second opportunity. But what was really insightful for me is that our most sophisticated LPs, they didn't hold us against it. They were like, you guys did the right thing because nobody has a crystal ball, right? That's why I say benefit of hindsight. So I think it's a balanced approach. But yeah, for sure. I think as you sort of evolve from an emerging manager into a more established manager, you can give yourself the luxury to sort of time it and just hold on to your positions longer.
And there is an expectation that next year we'll start to see a kickoff in IPOs, both in the US, certainly in Mexico. We're seeing it in parts of Europe as well, no? That the IPO market might start to reignite.
Look, even if the US stays closed, there's going to be 10 IPOs in Saudi Arabia. That market is open for sure. We're basically in all those companies that are going to list there. So we'll see, how that goes.
Do we have time for one more question?
Yeah, go.
So last question for the panel. And again, I don't know if we're going to open up or not. But it would be silly not to mention at this panel the lack of discipline that almost killed this industry in 2021, 2022, maybe before that. Out of 1,800 unicorns, half of them were minted in 2021 and 2022, which is crazy. And there's no denying there was a lack of discipline by many, many players in this industry that shouldn't have happened. That goes against consistency as a definition of success in venture. But you guys have been playing long enough, consistently doing well. So in a way, what's been your secret to stay consistent? And sometimes it's even playing against those strategies implemented in 21 and 22. But you have to go against the flow, and that was not popular at the time. So I just want to ask, how do you maintain that discipline, consistency of the craft of venture capital as opposed to just doing what the market is doing?
Rafa, you want to go first?
Sure. 2 things for us. It's process and luck. So process, which is mainly the driver you having an investment thesis, which is your vision of the world and where it's headed, and executing on that thesis consistently without getting sort of tempted to just go into the hype of stuff. And then luck plays a big part of it because luck decants in two concepts that are very well documented in venture capital, which is the positive signaling and persistence effect. And one drives the other, right? So if we were lucky enough, because that was luck, to partner at the outset of our firms, Fund 1 and 2, with top entrepreneurs. And those entrepreneurs went on to build huge companies that are now a signal for other entrepreneurs. And so that kind of drives your deal flow to some extent. And so it's easier for you to partner with those entrepreneurs later. I think venture is the only asset class where past results do predict future performance because of these concepts, right? And then the process piece is very, very important because it's very, very tempting sometimes, or it's very disheartening when you pass on a deal due to valuation or price or something, and then that deal becomes really successful. But that should be fine, because if you stick to your process, you'll get 2 out of each fund, even though maybe 16, 15, 14 companies will fail. And so those are the 2 main drivers first.
So 3 things. Being contrarian, as Alan said. When I first joined Kauffman, the first thing that they told us is like non-consensus, but you should be right. Which means you can do bets, but if everybody is betting on that, you might win, but it's not gonna be a big win at the end of the day. If you really want a big win, you have to bet on the contrarian deals. So I love underdogs at the end of the day. Second one is we are in a business called power law at the end of the day. So you do a lot of bets, 20 companies, let's say, most of them are going to die. And the downside is how we are going to manage that psychology. Even though we say it, it's so hard to lose your investments at the end of the day. But you always have to find those outlier returns, like 100x's, 200x's, and maybe more. So we are trying to surround ourselves with the best of the best, so we can talk to them and share our insights and talk to our mentors. That's the second one. And the third one is having a prepared mind, because as Pastor said, chance comes to the prepared mind, which means when you are lucky, you need to know that you are lucky. You have to be prepared to catch that chance, let's say, to invest in the company. That's why we surround ourselves with the operators, so they bring us that prepared mind too.
I think Rafa's framework of process and luck is pretty good. We use slightly different words, but the same idea that by nature of Endeavor Catalyst being rules-based, it does create a tremendous amount of discipline around what we do, right? And for those of us who work at Endeavor, we are entrepreneur first in everything we do. We're pro-entrepreneur. We want to be in these rounds. We're helping them raise them. But when they raise a round from a corporate or a family office, we don't invest, right? And that's been a kind of a hard thing over time. We've had to manage that tension of only investing when a really professional fund leads. But looking back at 21 and 22, man, that saved us a lot, right? Because for being honest, I don't think it's that the core people playing in venture capital lost their minds. It's that a lot of exogenous forces, like outside actors, came into this business, right? The crossover funds led the charge, but once they did, the growth equity funds were here, the sovereigns were here, like all these big pools of capital kind of came into venture. I think that it's almost like you're playing a soccer game in a small league with a couple of teams, and all of a sudden a whole bunch of new people come and they're playing a totally different game, right? Because they have completely different setups. And so, it was hard to figure out if you were one of these people, like, how did you react and how did you respond? But in some ways, I think Catalyst having the sort of strict rules that we do helped us a lot. On the other side, just to comment on Rafa's liquidity comment and tie it in, by the way, we entered Bitso in the $200 million round, but we still own all of it. So we'll see, where it goes. But we had 17 chances. It's important when you bring up this comment of all the minted unicorns, the data's out there. I think Mark Sister figured it out that 60% of all those new unicorn rounds were minted by 4 funds, right? 4 firms led the rounds that made all these new unicorns: SoftBank, Tiger, Insight, and Coatue. And for the most part, we didn't invest with them very much, right? Because we're investing much before them. But we had 17 chances to sell them shares in those crazy rounds. And we only sold 5 times because we were following our discipline and our rules of we only sold if our lead investor we went in with sold. Now, in hindsight, I'll say openly to our LPs, we should have sold all 17 times, right? If we had known, if we had understood everything of what was happening. So I think there's a little bit of luck in that component of it, but the discipline of the rules-based fund definitely helps us kind of through these crazy up and down times.
Yeah. So I think, I mean, it's time to stop again. I'm not sure if we're opening for questions and I am.
We're all going to be here for questions, but I think we're going to take a coffee break.
So what I would lend is the opportunity is massive. I agree that it's process. Luck happens. Luck is sort of this equally distributed. Depending on where you live, of course. In Silicon Valley, luck happens more often. If you're in Nigeria, it's a little bit less frequent, but it happens. It's process and being prepared for that. And process means a craft, a discipline of venture capital, which is a crystal clear investment thesis, crystal clear investment process, and areas of support. So thank you to our panelists. Thank you for everyone for listening, and we'll be around.
All right, thank you.